Good morning from our global headquarters in New York. I'm Manus Crenny. You're welcome to Bloomberg Brief. Let's set that agenda. Global risk markets mark time. Enthusiasm for China's stimulus pledge fades. Investors look ahead to the CPI later this week. A tale of two AIs. TSMC scores 34% November sales growth amid sustained demand. Oracle falls on lofty expectations. And we're live to London at the Bloomberg Women, Money and Power Conference. Conversation with Man Group CEO Robin Group coming up in the show. Good morning. We're marking time in these equity markets. What I can tell you is SocGen are saying get ready for 1,000-point swings next year. You're going to trade between 6,500 and 7,500, and it is going to be anchored with where the Treasury market is. By the way, momentum had its worst day of 2024 yesterday. Just saying. Roll it over and have a look. By the way, we'll catch up with Kallum Pickering and we'll talk about whether prices are high or expensive. Here's the bond market. SocGen, as I say, suggests that your equity rally is inextricably linked to the bond market. PIMCO have a pretty big note out that we've talked about on the Bloomberg terminal. Vigilance before vigilantism. They are less inclined to buy duration. They are reducing their allocation to the longer end of the curve. Steepeners are us. We'll talk about vigilance before vigilantism in just a moment. We're also keeping an eye on Alibaba falling after the Chinese signaled a bolder stimulus and eased their monetary policy stance. MicroStrategy rising in the pre-market after an announcement that it bought another $2.1 billion in Bitcoin as its funding draws scrutiny. And C3 AI shares climbing after the AI software company boosted its full-year revenue forecast. And in just a few moments, we'll sit down with Kallum Pickering, Chief Economist at Peel Hunt. And later this hour, Seema Shah joins me from Principal Asset Management. But first, investors are bracing for a new market environment.
This is dessert first in some ways, where everything is still possible. We haven't had the full cabinet announced. We haven't seen the actual policy proposals. This is a point where the market is free to dream and imagine that their preferred version of the next administration will be the version that we get. And that's a powerful force. Optimism, the dream is an incredibly powerful force in markets.
Let's see what Kallum Pickering dreams about. He's the Chief Economist at Peel Hunt. That was Andrew Sheets 24 hours ago. Dessert first, we dare to dream. I've got you down as a pragmatic Scotsman. But what level of dreaming and optimism do you have? Good morning.
Good morning. I'm constructive by nature. When I look at US markets, you mentioned this question, are prices high or are they expensive? Well, let's ask the question, what would need to happen to justify the high prices? Let's just play out next year. Resolutions onto geopolitical conflicts, the bond market to swallow the tax cuts. They're not inflationary. Europe strikes a deal on trade. Canada, Mexico strike a deal on trade. US, China
you are
don't
for
escalate
a lot, brother.
Too much. And the deregulation helps reduce US deficits, and we still get growth surprises to the upside in the US. That, for me, is what needs to happen to justify US stock prices. I think that's going to be hard. The question is, how does the correction play out, and at what point does it happen? Because if we're exuberant for 6 months, you won't want to miss out on that.
Do you think we should prepare for this kind of violent 1,000-point swing that SocGen talk about? I mean, look, they're putting their year-ahead forecast out there, inextricably linked to bonds. But I do get the sense that whilst we're all super optimistic and suffering a bit of FOMO, we should prepare for quantums of volatility.
Yes, I think so, because there's just so much material stuff to work through next year. What will be the net balance of effect of potentially immigration curbs, trade tariffs, and domestic tax stimulus? Will that be inflationary? Will it be pro-growth? It depends on how other actors respond. That's Europe, that's China. It depends on how far Trump goes on these particular measures. And then there's just the underlying US economy. Actually, the situation's been good. This is an economy that's been growing above potential for some 3 years. And what I grow nervous about is when everyone dismisses risks, and what you find there is the prices today reflect the fact that we've been outperforming in the US for 3 years, or that you're likely to outperform for the next 2 or 3 years. I think it's the former rather than the latter.
So the risk, a lot of people sit in their seat and they say you need growth for the equity market to continue to march higher. The biggest risk is, of course, that you have sticky inflation and a less aggressive Federal Reserve. And that sticky inflation is perhaps one of the biggest risks for 2025.
I'm worried a bit less about inflation.
Okay.
Just keep in mind, if Trump introduces aggressive trade tariffs near term, in the end, US consumers will pay for this somehow, but that would mean a stronger dollar. So you'd get a compensatory effect. So importer prices via a higher dollar would come down, and then you would get the effect. So that's not clear which way it goes. It won't be the risk that people are worried about. What I think we've got here in the US is a strong productivity upswing, which is helping to bring price disinflation down and keep it under control. We had something very similar in the 1990s. Greenspan didn't raise interest rates into an upswing. Why? Because he saw that productivity was strong on the underside. So I think that's the story with productivity. What makes me much more nervous is US 7% deficit. That's a problem. What happens if, for whatever reason, you get a business cycle downturn and you get some unemployment? And what happens if the good news priced into markets just doesn't play out and you go from speculative fever, which is I'm exuberant, prices are high, I think they can move higher, to ouch, actually the world's not like I thought it was before. And then you'll get these sharp corrections. So I don't think inflation's the risk. I think it's a medium-term risk. I think next year it's the deficit and it's just what's priced into markets that will be a big problem.
Then you probably subscribe to PIMCO's view, vigilance before vigilantism. Will vigilantism return in the way that we knew it in the 90s?
I think that we're going to have to see in the data. If we just look squarely at the balance of policies, tariffs are a negative supply shock, pushes up prices. Immigration curbs, negative supply shock, pushes up prices. Demand-side stimulus in an economy at full employment with 3% growth that's already running hot. The next thing to see is a little inflation. But when I look at US 10-year rates, we're trading at 420 today, that's barely 2% real GDP growth plus 2% inflation with a tiny bit of term premium. So there's a lot of trust in the US bond market that things are just going to play out fine. What happens if we don't get a fine outcome? And since the risks are spread to the upside, I think there's a risk that at some point next year, after a period of exuberance, the bond market just sees the whites of the eyes of inflation and then corrects.
And this is what we've got. We've got the term premium here, Kallum, which is the ratcheting in term premium into the election. Now, we've come back a little bit. We're actually at a 1 month low. And my question is fairly simple. That term premium, what is that pricing for me? Is that pricing status quo or next year? Or is there enough in there to really warrant being long of duration at the moment?
Well, the bond market, the US equity market is pricing in an everything will be fine scenario. And the rule over the past few years is we get overtaken by events. I hope everything will be fine, and I think the market, seeing prices rise, will not want to miss out. That's the FOMO that you mentioned. But we just need to recognize that underpinning this good situation today is a lot of two-sided risk. On the one side, inflation, on the other side, deficits. How can things get materially better from here would be my question. It's only on that basis you could then say prices need to move higher.
But for things to materially get better, you just need to take out the blocks, don't you? Which is tariffs are less aggressive. Deficits, Besant, Treasury Secretary-elect, delivers some kind of a deficit narrative that the bond market likes. He's targeting 3%. Yep. So there's various blocks that can be removed throughout 2025, aren't there?
I expect next year that we will probably get okay growth from the US, let's say 2% at moderate rates of inflation, and we'll feel like we're getting away with a lot of this. I don't think the deregulation on its own will be enough to bring down the US deficit to a sustainable level. I think you'll need active measures, whether that's the expiration of some of the spending that are not followed up by more spending, or whether it's active tax hikes. If we were to get negative supply shocks, which suddenly gave us 3 or 4 months of upside surprises to inflation, I think we'd find actually that bond market pricing is quite fragile. That would be my fear.
Okay, the fragility of the bond market. We're never far from a vigilante attack. Kallum, thank you very much. Good to see you this morning. That is Kallum Pickering of Peel Hunt. There are other stories trending on your Bloomberg terminal this morning. The Brazilian president, Lula, is in intensive care unit undergoing emergency surgery, according to an official statement from the hospital. A brain scan showed intracranial hemorrhage from an accident that he suffered at home in October. The procedure was uneventful, and he is in good health and being monitored. Israel stepped up its attacks on the military sites in Syria, striking some 250 targets, sending troops deeper into the country. The attacks follow Israel's seizure of a buffer zone along its border with Syria and airstrikes on Syrian chemical weapons. Israel's army radio, citing an unnamed defense official, described it as one of the biggest strikes in the Air Force's history. Prudential is considering options for its asset manager, Eastspring Investments, that includes selling a minority stake to help broaden the business, according to people familiar with the matter. A potential stake sale could value the Singapore-based Eastspring at about $3 billion. Coming up, TSMC sales grow by over 30%. We'll bring you the very latest on tech and AI in just a moment on Bloomberg Brief. It's Bloomberg Brief. I'm Menace Cranny in New York. Oracle met its estimates for revenue last quarter, but the investor expectations, well, they reached beyond the estimates. The stock fell 7% after hours, and the negative sentiment is continuing in the pre-market trade this morning. Let's get to Tom McKenzie. He joins me now. Tom, I mean, the market reaction here on Oracle, first of all, it's about the totality, isn't it? You've got the AI business, and then you've got the totality of the cloud business, and this is where there's a bit of a dislocation.
Yeah, exactly. You put your finger on the pulse in terms of the expectations around this stock, given it is up about 80% year to date. It had two blowout quarters, but not this quarter. RBC Capital Markets, their analysts coming out and saying, to your point, Manus, this was a mixed set of results, and given that expectations were elevated, that's what's led to the disappointment in terms of the market moves pre-market for Oracle. In terms of their revenues, they were actually up in the quarter about 9%. The sales from that crucial AI infrastructure part of the business that supplies the demand around cloud, that cloud infrastructure unit actually increased in terms of sales 52%. That was in line with estimates. So again, the second quarter numbers roughly in line with the estimates. The projections though around the current quarter, disappointment there in terms of revenues and profits, expectations coming in slightly lower than the estimates from the executives at the head of Oracle, but they still are pretty confident in terms of the outlook going forward. And again, one analyst quoted by Bloomberg saying this is almost an impossible task given expectations were so high. The chairman, the co-founder, Larry Ellison, saying we've got a massive deal with Meta in the works. They can be training their AI agents on our platforms, on our applications, on our data centers. That's going to be a boost. Bloomberg Intelligence thinks the picture remains pretty robust, but the numbers in 2025 will be scrutinized.
So when I look at TSMC, you begin to understand what the word dominance in a market positioning is. They've had a fairly robust November, but this is the 9th quarter in a row of where they've had near 30% growth. Talk me through what they've said about the results. About the sales.
Yeah, 34% increase in sales year on year for the month of November. Interestingly, to your point, Bloomberg Intelligence coming out and saying they have real pricing power now because of the dominance that you talk about. Pricing power against their competitors, Samsung, who face their own issues. Pricing power against Intel, of course, famously with our own challenges. And that could prove beneficial for TSMC going into 2025 as well. Bloomberg Intelligence saying the numbers that have come through from November suggest they are going to hit the high end of their guidance, and they expect, the team at Bloomberg Intelligence expect the momentum to continue into 2025. TSMC, the maker, of course, of those chips, not just for Apple, for NVIDIA, the GPUs, but also the infrastructure, the servers that go into those data centers. And again, the expectation is that on the numbers that came through for the month of November, propelled by particularly the high-end smartphone chips and those servers that go into the data centers, Bloomberg Intelligence thinks they're going to get to the high end of that guidance by the end of this fiscal year for, of course, TSMC.
You know I love a fact, and I found a fact, but I'll share the fact with you. Global Foundries business for them. They have 64.9% of the market share. There's your reason why Intel's got a few problems. Talk to me about Google. Yeah. Talk to me about Google and Meta. We've got the EU starting to probe into Google and Meta, and this is about how to communicate with kids, isn't it?
Exactly. This is according to reporting from the Financial Times that there was a surprise tie-up, essentially, a surprise advertising campaign, a secret advertising campaign, I should say. It's come off as a bit of a surprise to some. It seems at the top of the business at Alphabet, a secret campaign built out by Google, of course, part of the Alphabet family, and Meta to target under 18s in terms of advertising to push Instagram to that audience on YouTube. They tested it, they did a pilot in Canada, they were rolling it out, and then they pulled back from it. It actually went against Alphabet's own internal policies. The EU is asking for data and information as to what was going on behind this, again, reported secret deal advertising campaign between Google and Meta.
Tom, great reporting. Great up, Tom McKenzie there in London on the big tech stories. Coming up, we're going to hear from the Man Group CEO, Robin Grew, at Bloomberg's inaugural Women, Money and Power Conference. Context matters on Bloomberg.
Important is the thing that I think is important in that scale debate or that conversation too. So can you deliver what you have at scale efficiently and return as much alpha to clients as possible without losing it?
Let's get you up to speed with the front page news from around the world. These are some of the headlines. First up, the Journal starts with McKinsey promoting the smallest group of partners in years. The consulting giant elevates roughly 200 employees into its partnership. That's about 20% less than last year. McKinsey is still expected to expand its overall headcount throughout this year. Next up, CNN reports the Biden administration is rushing to secure a ceasefire in Gaza. Talks over a deal have resumed quickly but quietly about the ceasefire between Israel and Hezbollah. President-elect Trump says he would like to start his second term with both Lebanon and Gaza conflicts wrapped up and the hostages held by Hamas released. And on Bloomberg, Luigi Mangione has been charged in New York with the murder of the United Healthcare CEO Brian Thompson. He was arrested by the police at a McDonald's in Altoona, Pennsylvania, after being alerted by one of the employees. The 26-year-old man was found with a homemade gun and a manifesto which was described as anti-capitalist and of critical healthcare companies' profit motives. Well, as we said, we have the Women, Money and Power event in London. Let's listen in to the Man Group CEO, Robin Grew.
You're going to find us thinking about opportunities like that, but you will also find us growing organically our business. So, between our private and public credit business, we're north of $30 billion. And you can see that that matters to clients. I talk about clients all the time because they feed both how smart we can be. The danger is if you think that we can all turn up and sit at the table and come up with the singularly brilliant idea, that'd be great, and maybe we can do that from time to time. But actually the benefit is to have the brightest minds in the room, and that's between my firm and with everybody that we work for and with, to come up with that nugget of brilliance. And in listening to clients and being responsive to clients, it's about growing content, capability, asset classes that can answer their questions and be part of answering some of the navigation points we have today. It isn't straightforward out there. So we're going to see Man Group will grow through organic growth, through acqui-hires. If we can find acquisitions that are genuinely additive to us and accretive to us and to our clients, we'll do that. But it's a constant thing that you need to have at the front of your mind.
So as you look across your business, what products would you be most interested in potentially growing through acquisition? Are there any gaps that you see you'd like to build? Or
I think that it's a great question. It's one of those ones, though, that suggests that somehow there's a menu from which I can choose from at any opportune time. Wouldn't that be nice? That doesn't work like that, unless, if you know better, please let me know. So it is about assessing what's out there today and what's available at the right multiple, the right price, with the right scale, with the right culture. What I will tell you is it won't be something that we currently do. It will be something that adds uncorrelated content or capability for us. And when I say for us, I mean for clients. So what would I be interested in looking for? Do I like credit? I think credit's a cracking opportunity still out there. Can I grow it? Yes. Could I buy it if I can find the right thing? For sure. What I won't be after in this space is something which you can't scale. I think that there are very smart people in this audience today and very smart people sitting in my firm. And we can all get quite excited by small and niche businesses that do really funky and fantastic things. We can all be slightly distracted by them, and and it's brilliant, by the way. It's not to suggest they're not valuable. But if you can't deploy them at scale, that's less good for allocators who are trying to put money to work. So it's about having discipline in this space as much as anything else.
What about Man Group itself as a potential target? What do you think?
I think that I sit in this rarefied position of the CEO of this business, and it's a cracking business. It's been around for a while, you just mentioned, and my job, apart from anything, is to make sure that it is around for a lot longer.
That's the Man Group's CEO, Robin Grew, there, trying to deflect the last question about being a target, Man Group being a target, from Caroline Gage there at our conference in London. Women, Money and Power. The event happens today. Type in Live Go on your Bloomberg terminal. You can listen to the rest of the conversation with Robin and the board of speakers throughout the day. Coming up, the ECB will need to cut more than the Fed. That's the view from Principal's Seema Shah. From our global headquarters in New York, you're welcome to Bloomberg Brief. I'm Manish Cranny. Let's set that agenda. Global risk markets mark time. Enthusiasm for China's stimulus pledge fades. Investors look ahead to the CPI later this week. A tale of two AIs. TSMC scores 34% November sales jump amid sustained demand. Oracle falters on lofty expectations. And Citi's critical year. Jane Fraser is halfway through her 5-year plan to turn the bank around. Our exclusive interview coming up. Good morning. Having a look at equity markets just eking into the green. Momentum had its worst day of 2024. SocGen say get ready for a 1,000-point swing around, 6,500 to 7,500. We must debate whether prices are high or expensive. Seema Shah can answer that question. Let's roll it over, have a look at the bond markets. Fairly flat. PIMCO have a big note out that we've upsunned on your Bloomberg terminal. Flat at 4.21 is where we are on the bonds. PIMCO believe that we will have vigilance before vigilantism, and they are less inclined to buy duration. Reduce your allocations to longer dated bonds. You're going to have a steeper yield curve. Of course, we're counting down to the CPI. So much of this market narrative about where we go in 2025 will be predicated on the potential policies set by the incoming president, Donald Trump. He set the test, the economic resilience around the world. Global growth is set to come in at 3.1%. That is flat from 2024 in the latest economic outlook released by our Bloomberg economics team. Jamie Rush is part of that team, putting this grand paper together. Jamie, good to see you. Look, we're just over a month away from the new administration. And in terms of the seesaw of expectation, it is about tariff, it is about tax, it is about immigration. What's the base case for you and the team at Bloomberg Economics?
Well, I mean, the base case is that we think he's going to be relatively moderate. We have moderate voices in the administration. We know that if he was to do some of the things he's talked about on the campaign trail, like 60% tariffs on China, that would crater supply chains for US companies. He'd be punished in the markets for that. And so we think all of this points to him taking a slightly more moderate view than he's talked about on the campaign trail. And if you look at the Trump 1.0 playbook, you see that he was very careful the way he targeted tariffs. They were designed to reduce the inflationary impact. It was all on intermediate goods. And this made quite a big difference to the outcomes for the US economy. And we expect so there will be some similarities with that going into the Trump 2.0.
I'm just had a conversation with Kallum Pickering, of course, from Peel Hunt. He's saying, yeah, OK, so you get the tariffs, but potentially that stronger dollar, which to a certain extent or a proportional extent can offset some of the impact. Let's talk about inflation. There's a discomfort for you in where we land in 2025 in the United States and the UK. It's going to be uncomfortably above target in 2025, and that has ramifications.
Yeah, I mean, that's right. I mean, if you look at the global economy generally, what we see is a picture of really quite surprising resilience. If you think about the hiking cycle, if you'd asked any economist what that would have done to the economy, they'd have said it would have caused a recession. It hasn't, and as a result, labour market's still tight. We're still seeing inflationary pressure dissipating, especially through the US and the UK, not so much in the Eurozone. And clearly this is going to limit the capacity for many central banks to cut interest rates over the coming year.
OK, Jamie, thank you very much. You can pick up the latest economic release on your Bloomberg terminal. Jamie Rush there of Bloomberg Economics. My guest this morning is Seema Shah, Chief Global Strategist over at Principal Asset Management. Seema, that's the Bloomberg house view in terms of uncomfortably high inflation above target and steady as she goes growth of over 3% in the world. For you going into 2025, what's your growth outlook, first of all?
Hi, Manus. Yeah, actually very similar. So still expecting a soft landing, actually probably more than a soft landing, like fairly solid growth through the world next year. A lot of divergence, so you've still got the US leading, but that strong growth from the US should almost shine on the rest of the world and help bring up growth expectations everywhere. I think the key concern, as you pointed, is still going to be inflation. As long as you have got solid growth, plus you have all of the risks around tariffs, tax cuts, immigration, there is a chance that the US is going to have higher than expected inflation, which of course is then going to feed through to the rest of the world.
But do you think that can feed through to vigilantism? And this is the principle of what PIMCO are talking about. They see vigilance in the bond market before vigilantism. They talk about you don't really want to be long duration. If my risk is intransigent, sticky inflation, and indeed, if that is one of the biggest risks, and perhaps fiscal largesse, can you envisage that kind of roadmap, which is vigilance for now? We've travelled down in yields, but the potential there is for an attack of vigilantism.
I would entirely agree. I mean, I think when we look at what's likely with the regards to inflation, or actually with regards to rates, generally speaking, or historically, once the Fed has started to cut rates, bond yields have headed down. I think this situation is quite different in that you still have a very strong economy. If anything, economic expectations have improved since the Fed started to cut rates. And then, of course, as you said, on top of that, we have all the discussions around deficits, which is not just focused on the US, but you've already seen across in France, in the UK, that this is a global discussion. And as long as it's a global discussion, there's going to be global upward pressure on bond yields. So I'd agree. I think there's more of a risk of upward pressure on yields than there is downward.
I'm trying to get a grasp on what people think 2025 is going to look like from a risk principle. I take my mind back to the first Trump administration. It was overnight tweets, and it really dislocated the market. It created these massive air pockets of volatility. And this plays to what Soc Gen are talking about. Get ready for 1,000-point swings in the equity market. Now, you mightn't have that overnight. I don't know what we'll get next year. But is that what you're preparing for? Air pockets of massive volatility, which can create, I would say, opportunity rather than outsized risk?
So I think it's a really good point. So when we're looking at next year, we have got a fairly constructive perspective. We're expecting, as I said, solid growth. We're expecting fairly moderate Trump policy relative to Trump 1.0. But that is a concern, and that is a consensus view, which means that there is always going to be the potential for some kind of surprise, a bit of a risky atmosphere. And as you said, Trump 1.0, he did have the tendency to throw a little shocks into the market. And when you have got valuations as extended as they are today, both across the fixed income market and the equity market, that really does suggest some significant vulnerability. So the market, or at least the economy, needs to deliver, but we also need to not have any kind of surprises. So to me, the risks are a little bit to the downside, but the broad baseline perspective is a solid, or at least a modest, upside move in equity markets through 2025.
See, the worst mistake any of us could possibly make is to be sat out and under-allocate into 2025. How are you gripped by FOMO?
I think everyone who hasn't been invested or hasn't been sufficiently invested has to have some FOMO.
Yeah.
Just looking at the way that the market has performed, there hasn't really been any space which hasn't done well. It does mean that in 2025, it's going to be a little bit more challenging, of course, to get the same kind of returns. So we're not expecting like the 25% S&P 500 move that we've seen this year. We're not expecting credit spreads to continue to tighten. But that doesn't mean that you shouldn't have some kind of exposure, because as long as we're not anticipating recession, these risk assets can continue to perform fairly well. You have to be, as you said, there's going to be opportunities. Every time there's a dip, that's going to be an opportunity for investors to increase that exposure that maybe they've been struggling with under any of their FOMO emotions. So I think there will be opportunities, but certainly staying invested is going to be the key thing going into next year.
Well, let's face it, there's enough cash on the sidelines in money market funds to justify taking those opportunities. Laurie Calvasino says, look, we've possibly pre-traded some of the political tailwinds. I want to look at you very clearly draw this differential between Europe and the United States of America, and you talk about a juxtaposition of US strength and European economic anemia will be exacerbated in 2025. Stagnant economic growth implies continued disinflation, and the ECB will have to cut more than the Fed. What are the ramifications of that narrative?
Well, I think, first thing is that what we've seen from a political side in the US is simply reinforce a narrative which is already underway of US exceptionalism and Europe continuing to struggle. So this isn't a change in theme, I think, for anyone. This is just kind of almost exacerbating what was already there. For the ECB, of course, we are anticipating significant rate cuts through next year, taking it below neutral, whereas for the US, you could potentially see rates above neutral. Now, from a market perspective, it gets somewhat interesting because, generally speaking, that difference in fundamental perspective should suggest that US market should outperform. But the one caveat to this is that expectations for Europe are so negative. There is so much pessimism built into to the way that investors are thinking that you would need just to have a slight positive surprise in order to prompt some kind of positive movement from investors in terms of flows. Remember, valuations are very cheap in Europe relative to the US. So any kind of upside surprise, I would think, as a good opportunity for investors to increase exposure. We're not there yet, but we've been keeping a very close eye out for that.
Okay, we haven't quite reached that line of where you jump in. Seema, great to have you with me this morning. Seema Shah of Principal Asset Management, joining me on Markets from New York. Good morning. It is Bloomberg Brief. I'm Menace Crenny here in New York. Oracle met estimates for its revenue last quarter, but the investors, the expectations were for something a little bit loftier. The stock fell 7% after hours. The negative sentiment continuing pre-market this morning. Let's get to Tom McKenzie standing by. Tom, I'm just looking at the AI demand in these numbers. It is spectacular, up 336%. Why the misery?
Expectations, Manus, as is so often the case with the AI earnings story. One analyst quoted by Bloomberg saying the bar was just set so high after two blowout quarters. This was not the blowout quarter that some had expected from Oracle. But also, it was not a miss. They met estimates. As you said, revenues were up 9%. And importantly, from that cloud division, the cloud infrastructure part of the business that they're putting so much emphasis on, you saw growth there in sales of 52%, in line with estimates. The guidance on the current quarter, Q3, missed estimates. There's concern there. But again, executives at Oracle saying that they are still very confident in their strategy. They talked up some of their big customers like Meta, who will be training some of their AI agents on the hardware and software applications that Oracle provides. And again, this is a stock that's up more than 80% year to date. So with a bit of a breather, pre-market, you are looking at this big hit. But most of the analysts out there that have passed through these results suggest that the demand, the momentum is still there for Oracle.
So what's happening with TSMC? I mean, they had a hugely robust November. They have dominance that is the envy of Samsung and Intel. What's the read out there? The stock's just lighter on TSMC this morning by 1 1/3.
Yep, so sales up in November year on year for 34% increase a month year on year for the month of November. By the way, cast your mind back to January, where you saw sales of just 7.9% increase for TSMC. Most recent months, you've seen plus 30%. The expectations are now that for December, you'll see an increase in sales of about 36%. So it's looking healthy. Bloomberg Intelligence say these numbers from November suggest they will hit the higher end of their guidance for TSMC, which, as you say, Manus, is a bellwether in terms of that AI and data center demand. The growth coming through from the most sophisticated smartphone chips, but also that infrastructure, the servers that they provide into those data centers. It's a positive set of results for TSMC, and again, suggests that demand is going to continue, the momentum into 2025. That's the take from Bloomberg Intelligence, but they also say the scrutiny on those numbers month on month through next year will be intense.
Yep, well, they certainly got the dominant position, and as you said, Tom, a little bit earlier, they have that pricing power. Tom, thank you very much. Tom McKenzie tracking the tech story. Turn our attention to politics. President-elect Donald Trump's pick for Defense Secretary Pete Hegseth plans to keep fighting for the job. Hegseth appeared on Fox News and said Trump urged him to persist. Let's get a little bit more detail now with Bloomberg's Mike Shepard in Washington. Mike, good morning. Good to see you. So he's not backing down, but it also would look as if he has some kind of a shift in momentum from some of those on Capitol Hill. You've got Joni Ernst meeting with Hegseth, and she has shifted her position. Not her vote, but her position.
Well, that's an important distinction to make, Manus, and I'm glad you noted that, because she is directionally not coming out in opposition for Hegseth, but is not yet saying whether she will vote yes. And she also said, look, we're looking forward to a full hearing on his nomination. And we're still waiting to see what the FBI background check would yield. And remember, Hegseth is facing these allegations of sexual misconduct, alcohol abuse, and mismanagement at veterans groups. These are claims that he has denied, but nonetheless, they have put his nomination as Trump's defense pick on knife's edge. He can only afford to lose 3 senators' votes. And if some of those allegations really hold water as the confirmation process moves forward, it will be harder for moderates like Joni Ernst, who is not only a military veteran, but a sexual assault survivor herself, to then say, well, I will actually cast the vote for you. She is committing to seeing the process go through. Hegseth is continuing, as you noted, to fight for this nomination. And he is preparing to meet today with Senator Lisa Murkowski, and then tomorrow with Susan Collins. These are 2 other moderate Republican women senators whose votes will be critical, and they will be part of his ability to hold those three votes that he needs. Right now, though, he has the most important vote of all, and that's a vote of confidence from President-elect Trump. That said, Trump has been looking at possible alternatives, including Florida Governor Ron DeSantis as a possible backup in case Hegseth's nomination does go south.
Yeah, I mean, she is basically saying, Joni Ernst is saying he's committed, Pete has committed to completing the full audit of the Pentagon, and that's necessary for selecting a senior official. So it's about participating in the process. Let's talk about the potential dislocation between Canada and the United States. You've got the Canadian Prime Minister, Justin Trudeau, basically saying he will respond to Trump if he imposes tariffs. And he reflects back to what they did back in 2018. It was effective when they responded then. But we also have a little bit of a backwards and forwards. So there's a bit of a shift. I wouldn't say a tectonic shift from Trudeau, but it's more sort of an assertive moment for Trudeau. And then you've Trump's response.
Trudeau made these comments during an appearance with the Canadian Business Group, and you would expect him to come out and say, look, I am here to defend your interests, and especially given the political troubles he has been facing this year. So his remarks that he will respond in kind if need be, if the U.S. does follow through on this threat, are notable, and it signals that their concern remains very active. They do not think that Trump will simply walk away from this threat. And it's notable also that Trump made the threat of 25% tariffs across the board on goods from Canada and from Mexico, not as so much an economic tool, but as a way to gain policy concessions that would address his concerns over the border, namely the influx of migrants into the U.S. and the flow of fentanyl and other illegal drugs into the United States. And what he is saying is that neither Canada nor Mexico is doing enough. Trudeau has countered that, including by flying to Mar-a-Lago to meet with Donald Trump at his club and have dinner with him to say that, look, we in Canada in the North, we are doing our part. But at the same time, to this business group, he has to say, look, we are prepared to respond in kind if need be.
Well, we saw them respond on, what, bourbon, Harley Davidson. Say you're in the market for Harley Davidson. Playing cards, that's more the sort of the spectrum, the cost spectrum for me. And Heinz ketchup, there you go, Shep. That's the risk. Harley Davidson's to Heinz ketchup, retaliatory tariffs. Mike Shepard in Washington, thank you very much. A Bloomberg exclusive now. Citi CEO Jane Fraser is halfway through her 5-year plan to turn the bank around. Let's take a listen to the conversation with our very own Shonali Basak.
My ambition is to be a high-returning, high-quality earnings, modern, simpler institution that continues to play a shaping role in the global financial system. We're truly privileged to be as in as many locations as we are, with a talent base with such a global mindset and an ambition about it. So I think about we've got the right strategy and vision, we're executing with the right organization, we've got making sure we've got the right talent and culture in the firm, and that we're a simpler, well-controlled, modern organization. We'll have got the job done.
If you could give yourself a grade on the restructuring plan, what would you give yourself?
Oh, we aren't done yet, so I can't give ourselves a grade yet. I've always said that this is a multi-year journey. We're going to be very disciplined about making sure that we don't take shortcuts. And the problem with grading yourself along the way is it becomes too tempting to do a quarter-by-quarter grade, as opposed to we're just very, very focused and accountable for delivering what the end product looks like.
Speaking of the end product, you've set out a goal to bring returns on tangible common equity closer to 11 to 12%.
In the medium term and beyond after.
So Bloomberg consensus this year has Citigroup's return on tangible common equity at 6.8%. What do you say to critics that feel like you're not getting there fast enough?
Oh, we have undertaken a multi-year major transformation of an institution. We are working with ambition, with accountability, and with urgency. So we've already divested all but one of our international consumer franchises and wound down those that we couldn't. We've undertaken a massive reorganization of a company of 240,000 employees in 6 months, such that 50,000 people have a different manager than had 6 months ago. Now, it's been major change. We're being bold. We're ambitious. We're holding ourselves very much to account to deliver on the outcomes we should do. And I say, look at the proof. We're delivering, and we're determined to keep on doing so.
Citi CEO Jane Fraser there, an exclusive conversation with Bloomberg's Sonali Basak. Coming up in the show, I set you up for your trading day. Microsoft's annual shareholder meeting. We'll run you through the slate in just a moment, right here on Bloomberg Brief. Good morning from New York. Let's take a look at your day ahead. Microsoft has its annual shareholders meeting, and the NFIB small business optimism data is out at the top of the next hour. GameStop reports their earnings after the bell, and we've had a few earnings in the past overnight session. Oracle extending its post-earnings decline. The revenue was in line, but it just did not make the estimates that the market had out there. So we dropped post-market and pre-market. Norwegian Cruise is raised to a buy over at Goldman Sachs. Price target $35. And on eBay, Jefferies downgrades this stock to underperform on sluggish performance. So that's a note from them. Quick snapshot of equities. The question you need to ask yourself in this equity market is how much, according to Laurie Calvasino, have U.S. equities pre-traded the political tailwinds of 2025? Very similar to the 2017 run-up in stocks. Get ready for a lot of volatility. That seems to be the consensus. Air pockets will appear. That was the view from Seema Shah for next year. Right now, we're flat as she trades. The Bloomberg surveillance team will take you through the next couple of hours on markets. We're counting down to the CPI tomorrow. 0.3% on the core CPI, 3.3% year on year. And that will define the next trajectory move for the Federal Reserve. That's it from the Bloomberg Brief team. I'll hand you over to surveillance. Good morning.